Day trading commodities with knockouts and call spreads. I am Todd Rich. I'm the head of education here at Nadex. I'm not going to go through much of an introduction because we covered most of that during the earlier session on trading commodities with binary options. So I want to get right down into it. Before I start this session, again, I do need to share this disclaimer because the entire day, as well as each one of the sessions, are sponsored by the Nadex Compliance Department. And that trading involves risk and may not be appropriate for everyone. That any trading decisions you make are solely your responsibility and at your own risk. And these are educational sessions. Please do not construe anything we say today as a buy or sell recommendation. We are doing this for your education purposes. So what are we going to cover in this session? And in this session, we're going to jump right into it and we're going to talk what are knockouts. I'm going to define knockouts for you. I think knockouts might be the most intuitive product that Nadex has. They are very cool products. I think once I go through knockouts with you and I just define what they are and how they work and the risk and reward of knockouts, and then also the capital requirements. Remember, this is something that Nadex is very cognizant of, is we've built products for the retail trader. So we want to have products where you don't need large quantities of money to access price action in the markets. You'll understand that with knockouts. And once you understand knockouts, call spreads, I think, will be pretty easy to understand. So, and again, knockouts, I think, are the most intuitive product. And I'll explain that once I've and compare them to binary options and call spreads. I will do that comparison for you. And again, as I did with binary options, I find it is very useful to do a practical demonstration, and you can actually see knockouts and call spreads at work in the Nadex platform. It takes a lot of the mystery out of it, and it makes it much easier to connect the dots. I'm a big fan of visual learning. I tend to learn that way. So I do want to show a practical demonstration on the platform before we wrap up the day. And again, I want to remind you, if you've got any questions, we've been very busy today. I will try, if you type into your questions box, I will try to answer all of the questions. If for some reason we don't get to all of them, I will have someone from our team follow up with you on your question. So with that, let's get into knockouts. And what are knockouts? And first, I'm going to simply define them. And a knockout, again, it's a contract, but it's a contract that trades within a set range. Right? There's a predetermined range, and that range is between two price levels. We'll call the high price level the ceiling and the low price level the floor. So it's a contract that trades between a floor and a ceiling, and the value of the contract will trade directly in line with the underlying market, which means knockouts are what would be referred to as a delta one product. Unlike binary options, where you are trading the probability that the statement is going to be true, so you're actually trading a probability, and that probability will expand and contract or go up and go down based on time to expiration and volatility and price movement of the underlying. A knockout is a delta one. You are trading the value of that contract. If you think gold is going higher, you would be buying the price of that contract where gold is right now. If you thought it was going higher, you'd buy it. If you thought it was going lower, you would sell it. It is as simple as that. It is just like any other market. If you think it's going up, you buy. If you think it's going down, you sell. Now, some people say, how can I sell something if I don't own it? That is the nature of the contract. You're not physically trading gold or oil when you trade Nadex knockouts. You are trading the price of gold or the price of oil, and you're making a prediction. You're speculating that the price is going to go higher if you buy it, and you're speculating that the price will go lower if you sell it. And you can sell it, and your goal is to buy it back at a lower price and potentially profit. Now, that should be pretty straightforward. And that's what I mean by a delta one. There's nothing else in the price. You are directly trading the price of the underlying contract, which is a futures contract on gold or a futures contract on oil. It is a delta one, and you are trading the actual price. It is as simple as that. Now, how do knockouts work? I mean, if you're just trading the price, what's the point of having that floor and that ceiling? And knockouts will expire, because it is a contract, in one of two ways. It will either expire by price or it will expire by time. So let's first talk about price, and we call this price triggered settlement. If the underlying indicative index for that market touches the floor or the ceiling of the contract, you will have a price triggered settlement, and the contract will settle, and you will be knocked out of the trade. That is why they're called knockouts. If you buy an oil knockout, you think it's going higher, but unfortunately you were wrong and it went down and touched the floor, you would get knocked out of your trade. Consider it a stop loss. If you buy it and it touches the floor, you are knocked out of the trade. You experienced maximum potential loss. Again, with all Nadex contracts, we have very clearly defined risk, very clearly defined reward before you get into your trade, so you know exactly what you could potentially make or exactly what you could potentially lose. So if you bought a knockout and it went down, you would get knocked out of your trade and experience maximum potential loss. If, however, you bought it and it went up and it touched the ceiling, you would get knocked out of your trade and experience maximum potential profit. If it kept going higher, it doesn't matter. You couldn't make any more. The contract will already have settled. If it goes up and touches the ceiling and then goes lower, it doesn't matter. If it touched that ceiling, you were knocked out of the trade, you got maximum potential profit. And even if the price would tank from there, it doesn't matter. You've already recognized your profit. Now, the same way goes if you were to sell a knockout, you predict that the price is going lower. You sell a gold contract, you think gold is going lower. If the price indeed does go lower and you hit the floor, you would get knocked out for maximum potential profit. You sold it, it touched the floor, it went down, maximum profit. If, however, you sell a knockout and it goes against you, you sell a knockout and it goes up and it touched the ceiling, if it touches that ceiling, you're knocked out of the trade, maximum potential loss, but that was your protection to stop you. If gold were to keep going higher, you couldn't lose any more, you're already out of the trade. Now, the other way a knockout can settle is time. Our knockouts are all set as weekly contracts at the beginning of the week. So there is an expiration associated with the contract. All right, so if it doesn't touch, and that's going to be the very first question someone asks, I trade a knockout and it doesn't touch the floor or the ceiling, at the end of the week, it will settle at a price. It will settle at a price. And in that case, your profit or loss would be the difference between where you bought it or sold it and where it settled at expiration. And when it hit that time triggered settlement on Friday, when it settles, it will settle at a price, and you'll either have a partial profit or a partial loss. So how do knockouts work? And let's talk about how we set up knockouts. All right, because I just covered a lot, and I'm already getting questions about the dollar amount for a knockout, and I'm going to cover that. In fact, I'm going to set it up so that you understand why we do what we do, so that you can control the amount of money or capital you put at risk in a knockout, and that is why we offer multiple knockouts. So we're going to get there. When we start a week out, each knockout has a maximum of 1 week, and there will be 4 knockouts per market. So if you're trading gold, there are going to be 4 knockouts. You're trading oil, 4 knockouts. Natural gas, 4 knockouts. Silver, 4 knockouts. So all these commodity markets, there's going to be 4. And in the event that one of those knockouts is touched, so one of the knockouts in gold is touched, it expires, it's gone. Now you've only got 3. We will list a 4th one, and I will show you how that works. So generally speaking, you'll have 4 knockouts to choose from at any moment in time. And there's a reason for that. And this goes specifically to the question that just came in on your capital requirements. Now let's walk through an example of gold. I want to show you, and then I'm going to show you on the platform, but I think this will help a little bit. We started and gold was trading at 1820. Okay, we've got a chart. And this is the beginning of the week, and our gold contracts, the knockouts have a $50 range on them, and we'll create 4 knockouts with 4 different conditions. Knockout number 1, we'll take the floor down just a little bit, and we'll put the ceiling much higher. So we'll go down 10 points and up 40 points. Knockout 2, we'll make the floor a little bit lower and the ceiling a little bit lower. And we'll do that until we've got all 4 knockouts. Okay, and that way, each knockout has a distinct and different range with a different floor and a different ceiling. And here's gold at 1820. And let's look at what happens to a knockout as gold starts to move. So as gold starts to move, and here's the end of the week, if it doesn't touch the floor or ceiling at the end of the week, if it just went in a straight line, it will settle at the end of the week. Now let's go through a price triggered settlement where gold starts to go higher. So we started at 1820, gold went up a little bit, and notice how it hits the ceiling of knockout number 4 first. Knockout number 4 had the lowest ceiling. Now it touched that ceiling, contract number 4, that one with the lowest ceiling, it just got knocked out. It settles. Anyone who bought knockout number 4 made a little bit of a profit. They're knocked out for a profit. Anyone who had sold knockout number 4 just got stopped out. They sold it, it went up, and they're knocked out. Knockout number 4 is settled. It is gone. It doesn't exist anymore. And because gold was trading higher, we add a new knockout up above so that you'll see we would have 4 knockouts, all with differing with differing levels of ceilings and different levels of floors. Now let's go through the same scenario, the same setup, but instead of gold going higher, gold goes lower. As gold goes lower, of course, knockout number 1 has the highest floor. Because knockout number 1 has the highest floor, if you had bought knockout number 1 because you thought gold were going higher, it went down, it touched that floor, you're knocked out of the trade. Knockout number 1 will settle, and we would add a new knockout down below. That way, there are always 4 knockouts. Now, I'm setting you up for why there are 4 knockouts. We'll get there. Now, let's look at also, I just have to cover it because what if it doesn't touch the floor or ceiling? And I went a little quick there. And this is what we call a variable payout contract, is that while it has a defined risk, defined reward component to it, it may or may not touch the floor or the ceiling. So in the end, the actual potential profit or potential loss would vary based upon where you bought or sold it and where the final settlement is. And here's an example at the end of the week where we've got these 4 knockouts and it never touches the floor or ceiling of any one of the 4 contracts. It will settle at a price. All 4 will settle, and your potential profit or loss would simply be the difference between where you bought it or where you sold it. Now, let's talk about the concept of a knockout. And essentially what it is it forces you to be a disciplined trader. It has an inherent built-in trade plan when you go into the trade. You know your maximum risk and your potential reward before you even place the trade. All right, so those floor and ceiling, those are boundaries that give you a natural profit target with risk control. And the idea is this: if you're a trader, you should be a disciplined trader and have an idea of, for every trade, when you get into a trade, you should have an idea, where would I take this trade for a profit? If I sold this because I thought the price was going lower, at what point Would I say, thank you very much, and would I buy it back? And if you sold a knockout, that would be the floor. You also need to have a stop loss. And a lot of people ask, well, does Nadex have stop losses? Well, essentially, all of our binary options are inherently have a stop loss because they can only go to 0 or 100. So you choose the binary option that suits your trade. With a knockout, it's exactly the same way. You have an inherent stop loss where you can choose which knockout makes the most sense with the risk that's associated with that knockout. If I'm buying a knockout, I might want to choose the one with the highest floor. If I'm selling a knockout, I might want to choose the one with the lowest ceiling. And that essentially puts tight stops on your trade in the event that you were wrong. Now we offer multiple contracts, so you can choose how much risk you're willing to take in the event that you're wrong. But the very structure of a knockout forces you to have, before you enter the trade, an idea on where a profit target would be, as well as a stop loss level, because you have that floor and that ceiling, and all the contract has to do is touch that floor, touch that ceiling. The contract will settle. You're knocked out of the trade for a profit or a loss, one way or the other. Now, when you talk about the risk of a knockout, and I'm going to put all of this up there for you to see it, but this is your capital requirements. Your capital requirements are the maximum risk on the trade. All right, so how much money do you have to put up for a knockout is the risk on the trade. So what is that risk? If you're buying a knockout, the maximum risk is between the price that you're buying and the floor. If you bought it, your risk is it goes down and touches that floor. That's your maximum risk. That is what you're going to have to put up for the trade. If you're selling a knockout, if you're selling one, your maximum risk is it goes up and touches the ceiling. That is what you're going to have to put up for the trade. So when you're wondering what is the minimum trade size or trade dollar amount for a knockout, it's going to be how much risk is in that knockout. And we're going to get into that because we show you very clearly on an order ticket and on the platform what the risk reward is, and you can choose what risk reward profile suits you the best. Now on the reward side, just to be balanced, if you buy a knockout, your reward is all the way up to the ceiling, and your reward if you sell a knockout is all the way down to the floor. Now I want to show this in a visual way. I find that I can talk about it, but it really registers when I show you a simple picture. Now I'm going to go through an example of buying a knockout. All right, so we're going to buy a knockout, and if I were buying a knockout, I might want to choose the one with the highest floor. So I might choose knockout number 1. Why is that? Well, if I'm buying it, I think gold is going higher, and if I'm wrong, I just want to keep I want to keep my risk low, and that's how much I'm going to have to put up for the trade, is how much risk I've got. Let's look at this on a little graph. If I were to, and here's the time that I'm buying gold, all right, and here's the end of the week, and here's my floor. My floor is 1810. I knew what this knockout range was. I was buying, I know what the ceiling is up above, and I know where I'm buying it. I'm buying gold at 1820. I know my risk is if it goes down to the floor. And if I bought it and went down to the floor, it's very easy for me to see my red zone. That is the risk. That is how much I'm having to put up to put this trade on. And if it were to go down from 1820 at this moment in time and touch that 1810, that's my maximum risk. And that's what I'm putting on. Before I get into the trade, I know exactly what I'm getting into. Now, the green is how much I could potentially make. And so when people talk about that risk to reward ratio, you can choose which risk to reward ratio works best for you. If I were to have chosen knockout number 2, the red would be a little bit bigger. The The green would be a little bit smaller, but I might be comfortable with a slightly different risk to reward ratio, but it's a very graphical way for you to see what your risk is and what your reward is, potential reward is, if you were to buy. Now let's take a look at if I were going to sell. All right, if I thought gold were going lower, remember, I'm not actually trading gold, I'm trading the price of gold. If I were thinking gold were going lower, I might choose the knockout with the lowest ceiling. The one where if I sold it and it went up, I would lose the least, and that would be knockout number 4. So using the exact same situation, but inverting it, here's gold up at 1830. It looks like I slid my chart a little bit. I'm selling it at 18. Here's gold. I'm selling it at 1820. I know my ceiling is 1830. That's my risk. If it were to go up, that's where I would lose. And if it were to go down, that's where I would potentially profit. So you've got a very clear picture on, if I'm selling, how much risk, how much reward, to the downside. And if I were prepared to take a little bit more risk, I might have chosen knockout number 3. Knockout number 3 had a higher ceiling, so my red zone would be a little bit bigger. It also has a higher floor, so my green would be a little bit smaller. So exactly the opposite of the buy example. Here is the sell example. So that is one of the reasons why we offer 4 knockouts, is for you to be able to control your risk to reward ratio, and you can choose the risk to reward ratio that works best for you. And again, as a Delta One product, it really is as straightforward as, at this moment in time, here is the price. Do I think it's going to go higher? Do I think it's going to go lower? And you can use your speculation to take a position in the market, where if you think it's going higher, you buy. If you think it's going lower, you sell. Now, the capital requirements, and this goes directly to how much money you need to put on a knockout, is the risk when you place the trade. And you know your maximum risk before you even place the trade. You know, and I'll show you on the order ticket, you know exactly what you could potentially lose, and that is the capital requirement. So that is one of the reasons why we also have 4 knockouts, is you can choose the knockout that you have to put the least money up for. You can say, if I don't have thousands of dollars, I can choose a knockout where my risk is the smallest, and that way you can maximize your trading capital by minimizing what you need to put into a trade when trading a knockout, by choosing one with the least amount of risk. Now, this is something that is very cool. Your capital requirement will never change. Once you put the trade on, you know exactly what your maximum potential risk is before you place the trade. And after that, you put up that capital, there are no margin calls ever. There's no going, unlike, say, futures markets, where you have initial margin and then maintenance margin, and if the position moves against you, you might get a margin call, or if volatility goes up, you might get a margin call. No, with Nadex knockouts, because you have that defined risk component to it, your initial capital requirement, your maximum risk on the trade, is all you will ever put up. It will never be more than that, and you cannot lose any more than what you initially put up for the trade. And it doesn't matter whether you're buying or selling, those capital requirements are known up front. And that is the second reason why we have multiple knockouts. So we put up multiple knockouts for you to choose the risk to reward profile that suits your trade, but we also offer 4 knockouts so that you can minimize your capital requirements by minimizing your risk and choosing the knockout that minimizes your risk. And I think I should have covered the questions that came in, and they're not coming in anymore, so I think I answered that pretty well. Knockouts are pretty straightforward. A Delta One product, if I think the price is going higher, I buy it. If I think the price is going lower, I sell it. And I've got these knockout levels that will force me to either take my lumps and stop me out if I'm wrong, and I'll be knocked out of the trade, or lock in my profits if I'm right. So you should have a trade plan before you get into a trade, and a Nadex knockout is sort of inherent to that by giving you those levels that will knock you out of the trade. Unlike binary options where you're trading the probability of the event being true, and in the end it only goes to 0 or 100, these are, you're trading the underlying price, delta 1. Now let's look at an order ticket. Here's an order ticket for crude oil. At the time, crude was trading $70.62 a barrel, and it's a knockout that goes out a week. At this point, there was almost 4 days to go till expiration, and it gives you up at the top the clear floor and ceiling. Of course, we got a market. The market, if you notice the market, it is right around the indicative price. That's what I mean by delta 1. That 70.62 is right in smack dab in between the bid and the offer. Now, if I thought oil were going lower, I could sell this knockout. If I sold this knockout and I were wrong, the ceiling 71.25, that's where I would get knocked out. And here I'm trying to sell one again, I'm just showing an example where I'm placing an offer between the bid-ask spread. I'm putting that between. I'm trying to sell. I think oil's going lower. If I sold it and it went up to 71.25, I would get knocked out. I couldn't lose any more than $64. $64 is what I had to put up to do this trade. I was taking a speculation that oil were going to go lower in the next 3 days and 18 hours. And if oil went lower, I could potentially profit. If it went up and touched 71.25, I couldn't lose any more than $64. My losses were limited. That's the amount of money I had to put up for the trade. If I sold this and it went down to 66.25, my maximum profit, $436. If I were really right and oil were to tank and touch 66.25, that's what I could potentially make on the trade. Okay, pretty straightforward. And again, there's 4 knockouts to choose from. If I thought oil were going higher, I could buy a knockout, and I probably would have chosen a different one than this one. Again, I will show you that momentarily on the platform. Now let's talk about call spreads, because if you understand knockouts, call spreads are going to be really easy to understand. If I tried to explain call spreads before, it would have required a little bit more effort, but now that you know knockouts, you're going to understand call spreads, because a call spread is also a contract that has a predefined range, and that range has 2 levels, and it has a floor and it has a ceiling. Sounds really, really familiar, doesn't it? Which is why I think once you understand knockouts, you will understand call spreads. Now, the value of a call spread will move in line with the underlying, similar to a knockout. Similar to a knockout, but not exactly the same. There are subtle differences. Now, there are distinctly two differences between knockouts and call spreads. And these are very important to understand the differences, and this is what makes a call spread and makes it different from a knockout. Namely, number 1, a call spread will only expire at expiration. A call spread only expires at expiration. There is no price triggered settlement. So even though you have a floor and a ceiling, if a call spread touches the floor or the ceiling, you are not knocked out of the trade. You are still in the trade. Okay, so there's optionality associated with a call spread that is not there for a knockout. A knockout is a very hard level. You are knocked out. That is it. A call spread, however, does not have that price triggered settlement. If it touches a floor or ceiling, you are still in the trade. And because of that optionality, it is not a delta 1 product. It is going to have an extra premium value associated with the price of a call spread. a call spread will have a premium value. So, and because of that, volatility and time to expiration will impact the price of a call spread, just like it impacts the price of a binary option. If there's a lot of volatility or a lot of time left, the amount of that premium is going to be higher. If there's low volatility and very little time left to expiration, that premium level will be very low. And in fact, with very, very, very little time left to go, if you're right close to expiration and there's no volatility, the price of your call spread will actually look almost identical to the price of a knockout at that point, because price movement and time to expiration and volatility become less important factor into that equation of pricing the premium for a call spread. So hopefully that was clear, that knockouts, hard, distinct knockout levels, call spreads have optionality. Call spreads have that optionality. So if you bought a call spread and it went down through the floor, you're not knocked out. You have time for you to potentially be right and for it to come back. If you sold a call spread and it went and touched the ceiling, oops, you were wrong, but you're not knocked out. You have time for it to potentially turn around and come back and go your way. But for that, there is going to be a premium component factored into the price of the call spread. So for that optionality, it is going to cost you something. Now let's look at a call spread order ticket. And here's an example of oil, okay? And it's got the indicative price. Oil is trading at 70.60, and it had 18 hours to go in this contract. And I've got a floor and a ceiling. Notice that at this point, the floor and the ceiling, it's a $5 contract. The floor was 65, the ceiling was 70. We're actually, I think oil's going lower. I'd be selling, that's why I have the red sell. But notice where the indicative price is, it's already above 70. So I can sell this, but for this to even be profitable, not only would it have to go down to 70, it would have to go lower than 70. I mean, it's already up at 70.60. It would have to drop. And notice the price that I would have to sell it at. I wouldn't be selling it at the indicative price of 70.60. I'd be selling it almost $1 lower at 90 cents lower at 69.73. Okay, and there's an order for me to sell one in between 69.73. There is, what is that? 73 plus. Yeah, I mean, it's $1. I'm selling this 90 cents down, 87 cents, 82 cents down. Now, yeah, I'm selling this above the ceiling already, and I've got 18 hours for it to be right. But notice, yes, I'm selling it lower, but my loss, I can't lose any more than $27. If I sold this at 69.73, I know the ceiling is 70. I can't lose any more than $27. That's what I'd have to put up for this trade. If I thought crude oil were going lower in this time frame, I could risk 27. Now the floor 65, it's much lower. I could potentially make $473, but this is a way for me to say, I think oil is going lower. I want to sell it. A knockout, if I sold a knockout and it went up and touched the ceiling, I'm knocked out. Here with the call spread, I'm actually selling it already above the ceiling. It is costing me a little bit of money, but my risk is very low. And if I really thought oil were going to tank and drop a few dollars in the next 18 hours and 26 minutes, I could speculate it's going lower by selling a call spread and not having to worry about getting knocked out of the trade. Now, on the flip side, and this is actually important, in fact, actually, on the flip side is, if it goes your way, if you sold this oil call spread, if I sold this oil call spread and it went down through 65, I would not be knocked out. Remember, I'm still in this trade. It dropped below 65, and I know I can't make any more than 473. I don't care how low it goes. So if you didn't close the position, it could potentially rebound, and your opportunity to profit from a trade that was profitable, you would have missed it. So this goes to that rule that I talked about with binary options. And it's the same rule when it comes to knockouts or call spreads. Just because there's an expiration associated with the knockout or the call spread does not mean you have to wait until expiration to see what happens. If you buy or sell a knockout or a call spread, you can, just like with your binary options, choose to exit the position early. And you would choose to exit the position early to, again, lock in profits or limit losses. Now, with a knockout, if you bought a knockout, you know that and it goes down to the floor, you might choose the one with the tightest floor on it. But if you bought it and it started going up, do you have to wait for it to go all the way to the ceiling for you to get maximum profit? No, you might be looking to exit your trade earlier and take a partial profit and simply sell it at the exit level that you want, where you would take a profit for a partial profit, not the full profit. You do not have to wait and see what happens at expiration. You can get out early. And that is really important with that call spread. That call spread, you sell a call spread because you think something's going lower, and if it goes higher, you know that your losses are limited. But if it goes lower, if you don't buy it back lower and it comes back, you did not lock in profits if it went all the way down to the floor. You would need to close it down there. And you can do that by placing an order down below where you would buy it back and lock in your profits. But you would absolutely need to do that. Otherwise, it will stay on all the way till expiration. Remember, a call spread will go all the way to expiration. Do you need to wait until then to see what happens? Absolutely not. And that is really important. Now, again, I'm going to put this up there. Don't forget, please email customer service at Nadex if you've got any questions. I know I've covered most of the questions, and I'm going to cover these other questions when I jump over to the platform, when people are asking about price indicators and trends, and getting some education around what is available on the platform, as well as strategies. I'm going to jump over to the platform and I'm going to show you a little bit. I think it'll resonate a little bit more. So let's go ahead and bring up the Nadex trading platform. All right, I'm going to start with knockouts, and you can see, on I can switch between the products over here on the left-hand side. I'm going to start with knockouts, and I'm going to start with gold. Why not? And I think I'm going to click on any one of these. It doesn't matter which knockout I click on. I'm going to click on one of them just to populate the chart. I'm going to hide that. The reason I say it doesn't matter which one it doesn't matter which one I click on is because on the Nadex charts, on the left-hand side, you can see these 4 vertical blue lines. And if I click on any one of them, it's going to show me all 4 Nadex knockout contracts, and it's going to very clearly show me the floor and the ceiling. Now, if I thought gold were going to go lower on this knockout, I might choose this knockout, okay? And I'm going to click sell because I think it's going lower, and it populates that order ticket. If I sold this knockout, all right, and it's got 2 days and 22 hours. Again, this is not a trade recommendation. I'm just playing around. If I sold it, and look how tight these markets are. I'm going to join the off. I'm going to go ahead and sell one at 1776.20. Place the order to sell one. Okay, and look at that, it's ticking lower. All right, I placed my order. You can actually see my orders in here to sell one at 1776.20. All right, it's right above the market. If I wanted to see my order, there it is. There's, you know what? I just want to Yeah, look at that, 9,001. I got my one to, and it looks like I just traded it. Yeah, it's in a position. All right, so I just sold one. Okay. Now the reason it's showing me losing $1 because I sold it and it's assuming I'm buying it right back at 1776.30. Now I sold this at 1776.20. I'm speculating that the price of gold, and someone's asking how liquid are these binary options and call spreads. And now this is a demo environment, and it is pretty close to replicating production. This, you can see how liquid and tight these markets are. It all depends on the time of day and volatility, but you can look, again, what you experience in a demo environment is going to be slightly different from what you experience in a live environment, but it's pretty close right now. And if you had an account opened, you can take a look at the liquidity, but they are very liquid markets. I sold this if I sold it. If it were to go up to the ceiling, 1784, I would be knocked out. I can't lose any more than $78. This currently costs me $78 to put the trade on. I can't lose any more than that. No margin calls ever. What could I potentially make? It goes all the way down to 1734, where I would get knocked out for a profit. Now I know that I can't lose any more than 1778. Do I have to wait for it to go all the way down to 1734 and make all of this profit? No, I could. I've only got just about 3 days to go. Could I buy one back lower? Now, some people are asking about strategies. You'd have to come up with your own strategy, but I'm just going to, let's just play around. And people trade this just like they trade any of the other products. They're going to look at technical indicators. And just for fun, we've got a variety of technical indicators. If you don't know what these are, we have in-platform education with an I to help you out a little bit. If you need more than that, all of these indicators are standard indicators. There is so much education out on the web for you. I mean, you'll be overwhelmed. You probably won't have to look that far to find something that would help you understand. We've also got all of these indicators. Again, if you're not sure what any of them do or mean or how people use them, you've got the in-platform education to help you out. And ultimately, it's up to you to figure out what strategy works best for you. Now, I'm just going to play around with one that people use as an indicator. Fibonacci is a very popular one. I'm not going to go through what it is, but there is plenty of education out there. I know we've got some technical, I know we did, so there on the Nadex YouTube channel, if you look, you will find some videos talking about basics and introduction to technical analysis. If I were to click on this and look at recent moves in gold, I'm going to click the upper left for where it was high. I'm going to go down to the bottom right where it's low and look at these retracement levels. And it is rather interesting that we are sort of at the 50% retracement level right now. But I took a short position. Where would I potentially buy it back? Where would I potentially see support? Well, I actually know that this level right here, which is 1768, is an area where if it were to start going lower, it might get some support, which makes some sense. I mean, you can actually see that it was resistance here, and it did consolidate a little here before shooting higher. If gold were to come all the way back down here, I might see some buyers. So I might buy it back at 1768, call it 1768.50, okay? So if I wanted to buy this back at 1768.50, I can actually just go and put in 1768.5. Now I'm placing an order to buy one much lower, 1768.50. That's where I would, and I'm going to go ahead and place that order. And you can actually see I've got an order to buy it down below at 1768.50, and that would be to lock in my profits from the short that I took at 1776.20. Now I know that I'm knocked out. If this were to go higher, I would get knocked out at the ceiling, and I would try to buy it back right here for a partial profit. If I wanted to, if I really thought gold were going to tank, and you wanted to try to see if it would make it all the way back down to these lows, it might. You've got to make that determination. I can't really tell you that. You've got to make a determination on the direction and the extent of the move that you're looking for profits or losses. But with a knockout, you've got distinct levels that are predetermined to help you with that, but I do not have to wait until the end. I can try to look for partial profits, or if I'm wrong, I don't have to take a whole loss on this. If this were start going higher and I think, oh God, I'm gonna get knocked out anyway, I could just try to buy it back and just take a partial loss. Now let's take a look at a call spread before we wrap it up today. I'm going to go to call spreads. I'm going to go to commodities. Now let's go to oil. And let's refresh. All of these have since expired because we're later in the day. So let's. And now I'm in demo and something goofy is happening. So I'm actually going, oh, you know what? Because all of the commodities have settled. There are no more commodity call spreads. So I'm going to have to use, for our call spread, I'm going to use an equity index. Apologize for that, but at 1:30, all the commodities settled and we don't have any more call spreads available for commodities right now, but we clearly have them in other products. So here's the S&P 500. I'm just going to use the S&P 500 for an example. And notice how we've got different time frames for these call spreads. Here's one that ends at 3, this one ends at 4, this one ends at 4:15, this one's the end of the day. Let's just pick the one that goes until the end of the day. And I'm just going to click on any one of these call spreads. And the reason I say that is, again, I can click on the call spreads and they're going to shade what the floor and ceiling are. And notice we've got a variety of choices. Now, if I thought the S&P were going to bounce, maybe I think it's going to go lower. You know what? I think S&P, we bounced earlier and we just seem to be in this downtrend. I think it's going to keep going lower. Here's a call spread where I can choose to sell it. I think in the next 1 hour and 26 minutes, the S&P 500, it seems like everyone wants to sell it. They can't stand, it's just going to keep going lower. If I sold it, now notice, the indicative, it's currently trading 43.50. I'd have to sell it down here at 43.37. I could only lose $30, but it would have to make a pretty significant drop for me to potentially start making my money. But if it really were to drop out and go towards lows of the day, I could potentially make $370. All right, so you can see this is that premium that it's going to cost me to trade that call spread. Now, if I thought the S&P were going higher, all right, I'm just for argument's sake, I'm going to pick a different one. I think it's actually going to go higher. Here's one where I could buy the call spread. Okay, I could buy this call spread. Here's the floor is 43.40. Now I think it's going to go higher, so I'm going to try to buy this one at 53.30. Okay, I think it's going higher. All right, I think actually we're gonna rally. We're gonna get a relief rally going in to the end of the day in the next hour and 24 minutes. Notice how it's currently trading 43.52, 53. Look at the price I would have to pay. I'd have to pay above. That's the premium that I'm paying. That's the premium that I'm paying to buy this. Now, my maximum loss, because I'm already trading it at 43.50 and the floor is all the way down at 43.40, I'd have to put up $133 to do this trade. If it were to go lower, that's my potential loss. If it were to go higher, I could potentially make $267. And you can see the liquidity. I mean, there's liquidity here. And look at this. Since I should have bought it. It's done nothing but go higher since we started looking at this. Hey, maybe we'll get an end of the day relief rally. And maybe I think that's going to keep happening. But now that we're in the middle of this call spread zone, maybe it doesn't make any sense. If I wanted to trade this, maybe I would actually look at a knockout over there in the S&P instead of a call spread. So you're finding which product makes sense for you depends upon where the price of the underlying is, where that floor and ceiling are. I mean, here it might just be better if I'm going to take that kind of risk, where I might want to do this knockout, where it's a Delta One product. Here's the price I'm paying. I'm still risking that $140. Again, if it were to drop lower, I'd get knocked out of the trade. But if it were to go higher, I mean, so you've got to choose between knockouts and call spreads, which work better for you, which one suits your trade better. And again, you can manage the amount of capital you need based upon how much risk is in the trade. All right, so, and lastly, when it comes to looking at the charts and looking at time frames and trying to identify opportunities for trades, it's this where I would recommend you come to the morning analysis sessions, because we actually do live analysis before the markets each day. Now, we're not making trading recommendations, but if there's a particular hot spot in the market, we will take a look at where the volatility is, and we'll even play around with the charts and do some technical analysis. I do these with Brian Caprice, who started the day off, and he'll do some of his analysis on where he sees buyers and sellers, where he sees support and resistance, where certain indicators might be helping certain traders look for certain opportunities. So when you're trying to do some of that analysis and leverage the Nadex tools like the charts, looking for opportunities in the markets, whether you want to trade binary options, which are fun, exciting, $100 contracts, and you could choose short duration where there's a lot of volatility and a lot of action. Or if you want to look at knockouts and call spreads, slightly different products might have different ranges, but one has that hard and fast knockout, the other has that optionality in it. We do look at potential opportunities in the markets and help people along those journeys. I can't emphasize enough how much you might want to look at those morning analysis sessions or join us for those 8:45 a.m. Eastern every morning, live streaming on YouTube.